This is Hubwonk. I'm Joe Selvaggi. Welcome to Hubwonk, a podcast of Pioneer Institute, a think tank in Boston. Following rumors of potential insolvency and an attending run to withdraw uninsured deposits, on March 10th, the Federal Deposit Insurance Company, FDIC, stepped in and took control of Silicon Valley Bank, the 16th largest bank in the United States. This bank failure came nearly 15 years to the day after the collapse of Bear Stearns, the bank failure that helped trigger a global financial crisis, followed by a comprehensive raft of regulations known as Dodd-Frank to limit the risk of future bank failures. In the week following Silicon Valley Bank's collapse, politicians exploited the public's anxiety to either create narratives of greedy executives exploiting lax oversight, or instead blaming capricious bank board members concerned more with social justice than with financial prudence. However, the actual causes of Silicon Valley Bank's failure appear to be manifold, having some features unique to its investor-focused business model, while other systemic causes are shared by the entire banking industry. What were the causes of Silicon Valley Bank collapse? Who will pay for the losses incurred? What are the implications for the entire banking sector and its depositors? And what is the proper policy response to reestablish trust in our banks? My guest today is Dr. Norbert J. Michel, Vice President and Director of the Cato Institute's Center for Monetary and Financial Alternatives, where he specializes in issues pertaining to financial markets and monetary policy. Dr. Michel has written extensively on banking industry health, from the regulatory regimes following the global financial crisis, through different administrations and regulations, and now as banks face the challenge of remaining solvent during rapid interest rate rises. Dr. Michel will share with us his views on why Silicon Valley Bank failed, what vulnerabilities other banks share in a time of high rates, and what investors and depositors should know when they trust their money to an institution. When I return, I'll be joined by financial market and monetary policy expert, Dr. Norbert J. Michel. Okay, we're back. This is Hubwonk. I'm Joe Selvaggi, and I'm now pleased to be joined by Vice President and Director of the Cato Institute Center for Monetary and Financial Alternatives, Dr. Norbert Michel. Welcome to Hubwonk, Norbert.
Hi, Joe. Thanks for having me on.
Well, it's a pleasure to have you on. It's now we're recording a little more than a week after the collapse of Silicon Valley Bank and Signature Bank. And I know our listeners are concerned that where there's smoke, there may be fire. Most of our listeners were adults 15 years ago when the financial crisis of 2008 happened. And they're worried perhaps that we may be on a precipice of something similar. So what I want to do is have you come in and explain to us what is perhaps similar, what's different, what makes SVB a special case perhaps, but what kind of stresses are on all banks as we speak today. So before we get into the weeds, I want to start very basically for our listeners. How does a bank make money?
Well, typically a bank gets funds from somewhere, whether that be depositors or other securities, or other investors rather, or borrowing it, and then they lend out money. And the difference in the money that they pay to get those funds and the money that people pay them to borrow funds is how they profit. So they're looking at that spread, that difference.
So in very basic terms, if I'm going to oversimplify, I go down and I make deposits at the bank and they pay me, it's a little more these days, but 1 or 2%. Someone comes up in the other door and says, I want to borrow money for a house, and they're going to charge them 5, 6, 7%. The difference in there is where the profit is made.
That is it. Obviously we're oversimplifying this, but that is basically the idea. That's it.
So what our listeners will want to know is SVB, Silicon Valley Bank, as its name perhaps suggests, had a different kind of depositor and frankly, different types of assets. So share with our listeners, what is different or special about Silicon Valley Bank?
Well, what's different about them or special about them is that they were highly concentrated in one area, in one industry. And that by itself is a little bit unique in that most banks are much more diversified. Most large banks are much more diversified, whether it be geographically or throughout different industries. But Silicon Valley Bank was not. And it looks to be the case that a very large proportion of their depositor base also all looked very similar. It was a lot of venture capitalist guys, a lot of VC guys, a lot of tech guys. And that is also not the norm. Again, there's usually a broader base of depositors than what you saw there.
So contrary to my model, where it's ordinary guys going in, dropping off their hard-earned money and their paycheck and perhaps borrowing, these are different. These are, as you mentioned, investors, venture capitalist guys with tens of millions of dollars,
Yeah.
many of whom know each other. But these guys seem like they're wealthy. They know finance, they know investing. How does that profile compare with, let's say, a bank that has just ordinary, run-of-the-mill investors?
Well, theoretically, it's different in that you have much more sophisticated finance guys. And there's a lot of controversy over this right now, but I would still, until I see definitive proof otherwise, those those depositors are more sophisticated and in tune to finance in general, and hopefully to what their bank is doing. And then I'm a finance guy from way back, and this isn't anything new in that large institutional type investors, people or companies with large sums of money, those are the ones that are most likely to run at the slightest sign of trouble, as opposed to, say, you or me with maybe a couple hundred or a few $1,000s in the bank. We're covered, we're insured, we know that. They're not covered and insured over, a very small amount for them, and they know that. So this isn't really surprising as far as that goes.
So you mentioned a term called insurance. Our listeners have heard this term FDIC insured. It's on the bottom of our statement. I think while we're sitting there at the teller, there's a little sign on the desk that says FDIC insured. What's the difference between an insured deposit and an uninsured deposit?
Well, before last week,
Theoretically, we're talking theoretically. How is it supposed to run? So
yeah, the way it's supposed to go is that if you have an account, you are covered, provided you're fully insured. You will not lose a single penny, provided that that account is up to $250,000. You can have multiple accounts, but in multiple banks, but each one of those accounts, you're covered up to $250,000. If you have more than $250,000 in that account, the FDIC does not stand behind it. It is not insured. So if the bank fails, there's a chance that you're not going to get all of your money. Whereas if your account is below 250, you will get all of your money.
So as we said, many of these depositors have far in excess of $250,000, 10 million, 25 million, and all of that money is at risk if the bank fails. So we've established they're sophisticated investors with lots of or depositors, I suppose, with that are in a common industry. They may know each other. They're not insured. So when rumors, and I think there were rumors that were around for several weeks, that there may be some trouble with SVB. What was the reaction of these depositors? What precipitated this collapse?
So they ran. Basically, another piece, I guess maybe I left that out. Another thing that makes it looks as though SVB is a little bit unique, is that they had a lot of unhedged exposures to interest rate risk. So when again, this is, there's a lot of fog here, so I don't want anyone to take this as gospel, but what it looks like happened is that as more people recognized there was more of an unhedged risk than what they thought, that's when there was a panic, and people said, okay, they're going to come in, and the bank's losing money. It's going to go down. We're not insured. We got to get our money out of there. So they panicked / ran by taking their money out and moving it somewhere else so that they could make it safer.
Okay. All right. So you're touching on two elements, and I'm not sure in which order I want to take them. But when I drop off my bank deposit, it goes, I think, into a vault. But actually, it's not like we see on It's a Wonderful Life. George Bailey is not sitting there with a safe in the back. It actually gets invested. So as you mentioned, to protect it against the ravages of inflation, but it also wants to invest in a very, very safe way. So they want to get some return in a very, very safe asset. Describe to our listeners, SVP took the money that they held in reserve and invested it. How did they invested it, and why were the depositors so concerned, in this current environment?
Okay. Like many banks, I would say like most banks, they put a lot of that money, they invested a lot of that depositor money in treasuries, many of them long-term treasuries, and also government-backed mortgage-backed securities, or Fannie and Freddie, GSEs, mortgage-backed securities. So you could consider it a big bond portfolio. And that by itself is not unusual. And generally, just broadly speaking, not particularly risky, in and of itself. But when interest rates go up, the value of all those bonds goes down. And it works in the opposite way too. If interest rates go down, those bonds become worth even more money. They go up. So right now, interest rates are going up, the value of those bonds are going down. And as people started getting nervous about what the bank was really worth, and because of the market value of those bonds going down, they wanted to get their money out. Well, then the bank had to sell some of those securities to get the cash to pay off their investors. Well, interest rates are going up, the value of the bonds are going down. So when they sell them, they're taking a loss. And you're taking a loss, that means your capital cushion is going down. Now you're becoming even riskier. So you sort of get into this dangerous kind of spiral environment where if you, on paper, you're losing money. And if anybody wants their money out, now it's not just on paper you're losing money, you're literally losing money. And then that makes the bank more fragile and even riskier. And that's what we saw happen here. So instead of hedging with other bonds, so that you had a strategy where your losses would be equalized by gains, with sort of like well, I hate to say derivatives, but you could use derivatives and you can use other bond buying strategies so that if you do have to sell some of those bonds at a loss when rates are going up, that you're okay on the other side and you offset some of those losses automatically. I'm not sure why Silicon Valley Bank didn't do more of that, but it looks like they didn't do very much of that, at least for this recent period of time. And it's, again, not clear why, but it looks like that's what happened. So with the unhedged losses, that was worse. That was the worst case scenario for them. And that's what panicked people.
I want to drill down on this particular idea because a lot of, again, the partisan narrative is that these banks failed because of undue risk. What you're describing to me is a bank that, not atypical, but actually did quite the opposite. These assets were invested in a way that were so safe that their return wasn't able to keep up as let's say prevailing interest rates went up. In other words, their bonds. Let's do a little lesson for folks who don't understand how bonds work. If I buy a $100 bond that pays 2%, and I hold it to maturity, it's great. It's always worth $100 when I sell it. But if I want to sell it before that, and interest rates have gone up to 4% or something like that, in order for my bond to be worth 4% yield, I have to discount the bond. I have to sell it for $98. So my bond, which I bought for 100, is now worth 98. If I've got billions of dollars worth of these bonds, that's a huge loss. Can you describe that situation for our listeners a little more carefully?
Well, you just did. You did a really good job there, Joe. I mean, that's it. And if you or I lost $2, I would imagine, we're not going to like it, but we're also not going to, have a heart attack over it, right? But if you're holding, billions of dollars or hundreds of millions of dollars worth of bonds, and all of a sudden we're losing small fractions, we're talking about losing millions of dollars. And if we were in a position that we had that much money, we wouldn't like that at all. You don't acquire wealth by not caring about losing large sums of money. So it is a problem. The unhedged part, that I'm just not clear on why and on exactly why that transpired here. But it looks like it did, because you can get involved in all kinds of different swaps and derivative trades, very safe interest rate futures and stuff, that that if the rate environment does change, whereas you're losing money on one part of your portfolio, you're gaining on the other side of your portfolio, so you offset some of those or most of those losses. And my understanding is they used to do that more regularly, and I'm just not clear on exactly why they didn't all the way.
Well, far be it from me to be an apologist for SVB, but in my interpretation of the narrative is that this bank very recently, its deposits had exploded, and this was during a time when we had near zero interest rates, and venture capitalists, as you say, want to get return on their money. So if money's free, they borrow a lot, they deposit a lot, and everybody makes a fortune. As those interest rates start to rise, two things happen. One is, as we mentioned, the bonds that are held in reserve become less valuable, but also money gets deployed elsewhere, and those deposits start to leave. So at the same time, deposits are leaving, the assets left behind are worth less. So we've got this almost perfect storm. I don't want to put words in your mouth, but do I have it about right?
Yeah, no, that's it, really. That's why I hesitated to give a different explanation, because you've nailed that one. That's it. I guess I would really quickly point out too that this isn't some kind of like crazy idea that the bank would put all this money in treasury bonds, right? I mean, this is basically what you have here is the typical look for all banks now, especially after 2010, is that the regulatory framework, regulatory regime, for lack of a better term, it pushes every bank to do this. So the idea is that government bonds are safer. So get into government bonds. Mortgage-backed securities are safer. Get into the mortgage-backed securities. So that in and of itself is a policy outcome too. We should also point that out.
All right, so we're going to say this is not necessarily business as usual. Perhaps there was some carelessness or lack of sensitivity to the risk of rising interest rates. But let's talk about who is making sure my bank doesn't fail. Well, let's get into the regulation element of this. We all hear about the Fed, but I think our listeners may imagine the Fed is just one large national entity. It's broken up into little Feds. Each one has its own president and does its own research and work. Tell our listeners who's making sure bankers aren't asleep at the switch.
It's supposed to be the San Francisco Fed. And you've got multiple federal regulators. So if you're a federally chartered bank, the comptroller also regulates you. And if you're a state chartered bank, the FDIC could also regulate you. If you have FDIC insurance, which all banks do, the FDIC can regulate you. So if you're a state chartered bank, you've got a state regulator also looking after you. So you've got examiners from the San Francisco Fed, based on where SVB was headquartered. You've got FDIC regulators as well, and state regulators, all looking at the bank and what they're doing. So they're supposed to, make sure they're supervising the bank. They're making sure that they're abiding by their rules. And people like me have said for a very, very long time now that all we've been doing over the last century is coming up with more and more and more rules. They all amount to more capital restrictions, more liquidity restrictions, more boxes to check. So if you have this much capital, you're okay. If you have this much liquidity, you're okay. And that's what you do. And you can look at the financial statements, the recent ones available at least through 2022 for SVB, and yeah, they check a lot of boxes. Now, there's more to it than that. So I'm not just, again, I am oversimplifying it, but we have all these different federal and state regulators going into the bank, making sure they check all the boxes. And somebody's supposed to be looking at that and saying, hey, you've got a lot of risk here. Hey, there's a lot of risk over there. Gee, it really looks like you're over concentrated in one area. Let's talk about that. That's supposed to be happening amongst all three of those regulators.
So again, I want to challenge some of the dominant narratives that we hear in the news. One of primarily from let's say partisans on the left regard banks now as wildly unregulated. The narrative, I think, is after the collapse of the global financial crisis of 2008 and 9, we had Dodd-Frank, which imposed all these guardrails, so it could never happen again. And then a new administration, 2018, had different regulators who somewhat watered down the barriers or the rules that constrain banks. And all 5 years since 2018, we've had a ticking time bomb, and this collapse was inevitable. Is this in any way related to the change in regulation that occurred in 2018 or any time in between when Dodd-Frank was passed and today?
I have a very, very difficult time seeing how. I really do. For some of the reasons that I just mentioned as well. But this is a long-term trend. You can go back to the Dodd-Frank stuff. You hear people in Congress saying, "Oh, well, we deregulated the banks." Well, we didn't. That's just not true. And then in 2010, they passed Dodd-Frank and they say, we've got all these new protections and we're never going to have this problem again. Well, you should probably know that that's not true. And then in 2018, yes, we did amend the Dodd-Frank law. But if you look at that bill, the bill is S2155, long economic growth something name. But you can look at that bill and the sections that amend Dodd-Frank, which I believe are in section 4, title 4 of that bill, it's 5 pages long. There's just not much there. And what the biggest thing that it did was change the threshold for what we would call enhanced supervision. But a couple of things there. One, enhanced supervision really, again, only means possibly slightly higher liquidity and capital restrictions. That's for the most part. And then on top of that, they did change the threshold from 50 billion to 250 billion, but there were a lot of exceptions to that. So it's really more like they changed it from 50 to 100 billion. The regulators always had discretion in what they did with those thresholds. And the other really big factor here is that these are holding company restrictions. So they're not the operating company itself, the insured depository institution itself still had to meet the Basel III requirements. So these are not impacted by Dodd-Frank or by the law that amended Dodd-Frank. And some people have also pointed out that they had less stress testing because of the 2018 law. And again, that's not what stress testing was for. Stress testing is supposed to be for adverse economic scenarios. We're looking at the last crisis, the 08 crisis, and can we stop that from happening? The stress test wasn't supposed to look at sort of individually idiosyncratic, if you will, screw ups at the bank. What if your own investments went bad? It was supposed to be a macro prudential view. Supposedly, that was the only blind spot in our regulatory framework, and Dodd-Frank had supposedly fixed that. And this is not a macro issue that went down here. So it's just incredibly difficult to see how those 2018 changes had anything to do with this. Banks have always been highly, highly regulated before Dodd-Frank, before 1999, after Dodd-Frank, after 2018. It's really, really difficult to see how that any of those changes did anything that would have brought this out. The last piece I'll say about that, yes, the threshold has changed, and we can debate about whether that was good or bad or exactly where the extra regulations kicked in and how much discretion we had. But if you look over the last several years, last decade or so, you can see SVB moving over those thresholds. And it doesn't really change very much, it being its capital position and its liquidity position. So it had checked all those boxes, even for larger banks. In some cases, they had higher capital and liquidity ratios than even the largest, most restricted banks. So again, incredibly difficult to see how any of those changes had anything to do with this.
Indeed, as they say, we're always fighting the last war. The 2008 crisis was a function of the deposits or the assets that banks held were not worth what they were supposed to be worth, right? They were garbage assets. So that was a credit crisis, right? A credit quality crisis, not a liquidity crisis. So what we have in this case is a bank's assets met all the requirements of Dodd-Frank. The regulators had the prerogative to scrutinize what you characterize as idiosyncratic risk, which is, we covered early in the show, SVB is very idiosyncratic. It's a very special bank that had unique challenges. Regulators had the prerogative, but didn't do it. This is beyond the failure of the bank itself to anticipate interest rate risk. Regulators failed here too, because their purview allowed them to anticipate what seems to me, again, the wisdom of hindsight, to be an obvious danger. Do you want to say anything more than that?
That's right. No, that's exactly right. And everything's obvious once you know the answer, right? So that's and the last thing I'll touch on there is the kind of one of the things that you brought up there in the '08 crisis. It was all these toxic assets, these things that didn't turn out to be worth what we thought. So the idea after that was, we'll make them safer, and you'll have to have more government bonds. Well, okay, but they're still bonds. And interest rates don't have to stay ultra low and not move very much forever, and that's probably unrealistic to think that they would, but that's what we did. And then that's what happened. Rates started going up. So
all right, so I want to, I'm sure listeners are wondering, okay, there were mistakes made. The regulators will probably keep their jobs, but what about the banks? Who loses money here? I'm let's say I'm all three. I'm a depositor at SVB. I have a stake in the company. Maybe I'm on its board. Who's going to suffer from this? Many manifold mistakes.
The shareholders, the board probably as well is going to suffer. It looks as though depositors, and I guess you would have to say depositors who are not shareholders or not board members, they're going to be made whole here. So it's not we've been careful about this, I think, over the last couple of weeks. It's not a bank bailout in the broad sense. And you don't see a lot of the kinds of things that you saw in 2008, but it is a bailout nonetheless, in that you had a whole bunch of people whose money was supposed to be uninsured and at risk, and it turns out that it's not. And that's where we are now.
So it's a depositor bailout, not a bank bailout. So everybody who owns a share of that bank is wiped out. But the depositors, even if they're venture capitalists with $20 million in the bank, their deposits are protected or insured by the federal government. Okay, so we figured out who is at fault, who's going to lose their shirt, but we also talked about the fact that now, as of 2 weeks ago, prior to 2 weeks ago, we all thought we were insured up to 250. Now we think we're insured to perhaps 250 million. What is the risk now imposed there? If I now believe, I mean, I can see why the government would do that. We don't want everybody to panic, everyone to withdraw their money and have a global bank run. But if I don't have to worry about the health of my bank, what they call the moral hazards? What are the knock-on effects of having everyone assured that all their money is guaranteed forever?
Well, one of them is that you have more people with a lower incentive to care what the bank is doing, right? And that means that you're dependent on a smaller number of people to not screw anything up. And that includes a small group of regulators. You're expecting them to sort of have perfect foresight, and that's just unrealistic. And you're expecting things to never go wrong, and that's also unrealistic. And to basically, what happens is you end up where people who are running the bank and who are running the investments, although they do have an incentive to not lose their jobs and not do anything crazy, but they have an incentive to take more risk. They can take more chances. And if they meet more regulatory requirements, if they're over and above minimums, for example, then they can get away with more risk. So that's nothing new. So there's a moral hazard component there. And, we might not find out that it's risky until we're in a situation like we're in now. And it's like, well, oh, we should have never let that happen. Well, okay, but nobody ever thought about that. Before that went wrong, nobody thought that was so risky. But there is that risk there. And then on the I think what I would call is sort of like the broader long-term risk, or downside maybe, is that somebody's going to pay for all this. So you're going to have the government step in and clean everything up and say, well, because we're doing that, now there are going to be even more regulations. And because we're doing that, we're going to increase the assessment on deposits for deposit insurance. So the fees are going to go up, even if your bank didn't do anything wrong, right? So, well, okay, who's going to pay for that? Well, we all are. It's an increased cost, and it's going to get passed on to depositors to some degree, whether it's fewer employment opportunities in banking, whether it's less pay in the banking industry, and or whether it's higher account fees across the entire industry and higher interest rates across the entire industry. Somebody has to pay for that. Those higher fees are going to come from somewhere, and the higher regulation is going to make the system even more dependent on, for example, a group of regulators at the San Francisco Fed. And, it's again, unrealistic to do that, and hope really, and depend on them never messing anything up. That's not creating a diverse, robust financial system. That's creating a very weak, fragile financial system dependent on one or two people to not screw anything up. And that's not good.
And indeed, I don't think our listeners will take any comfort in those remarks. I wasn't going to bring it up, but the other bank, that high-profile bank, Signature Bank, also failed. One of its board members was, one would think, a very, very understood banking regulations very well. Barney Frank, he was one of our congressmen. We sent him to Washington from the great Commonwealth of Massachusetts, but he sat on the banking regulation committee for a very long time. In fact, the Dodd-Frank regulation we were quoting here, he's the Frank of Dodd-Frank, and his bank failed, even though he was on the board. Again, one would think, as a fiduciary on a board and one who's a skilled regulator and understands the four corners of the Dodd-Frank regulations and the dangers of banking, wouldn't want to assume that Barney Frank being on your board would make you the last bank ever to fail for, let's say, poor management. You'd be kind here.
Yeah, I bet it sounds like he's just as surprised as anyone too. So, but I know less about the details on the Signature side. It looks like there were, I don't want to say anything too strong about Signature because I am not as comfortable with the details, but it looks like there's a lot more controversy around exactly what happened and exactly what their status was. But as you say, you've got the Frank and the Dodd-Frank. He knows what the regulations are. He knows what the rules are. He knows what the warning signs are supposed to be if you take him at his word. And yet, here's the bank that he's on the board of going straight down. So it is very unusual, at least in my lifetime, to see something like this happen.
So going forward, our listeners, I think they're somewhat assured that the government stepped in and guaranteed depositors. So those people with money in a bank beyond the insured level can take a little comfort, at least for now, in that. But going forward, what are the likely reactions from depositors? Is everyone going to flee either to big banks or small banks, or you mentioned there's going to be some change in how banks are managed. Does this favor one type of bank over another going forward?
Well, yeah, it does. It does at the moment favor the largest banks, and you do see some deposit movements right now, from what I understand. people taking money out of the smaller banks and moving them into the larger, quote unquote, too big to fail banks. Lots of people, myself included, back in 2010 or around 2010, said that Title I of Dodd-Frank was a bad idea. If you want to prevent too big to fail bailouts, the last thing you want to do is identify the banks that you already believe are too big to fail and formalize that in US law. And that's a big warning sign. Yet that's exactly what Title I of Dodd-Frank did. So obviously you've got people looking at the situation saying, I don't care what you're saying about the insured. Some people are saying that it's not all covered. Some people are saying it's only systemic risk if it's covered, is covered. I'm putting my money in the biggest banks. I'm going to JP Morgan and Citi, the quote unquote GSIBs, globally systemic important banks, because they're not going down. We know they're not going to, the government's not going to let them fail. So that's where I'm going to go put my money. And that's what you see happening right now.
So effectively, the government provides as I say, an insurance subsidy, if you will, that says,
That's right.
you know, this bank, small bank, you take your own risk. This other bank, we're going to make sure you don't lose. So what's the downside? You said there'd be fewer banking jobs, and perhaps no listener is going to cry over that. But we all know entrepreneurs who rely on these smaller banks for, let's say, portfolio lending. They want to know your unique risk and your unique opportunities. It's very difficult to go to a big bank and know anyone's name, get your calls returned. Those small banks do play a role. How do you think that'll affect the American economy going forward with fewer, let's say, portfolio banks out there trying to invest in small business?
It's not a positive impact. It's not. It will be difficult to measure, but it's definitely in the direction of harmful. It's going to be harder to do capital deals. It's going to be harder to just, in general, capital formation is going to become more difficult. It's going to be difficult to get loans. It's going to be a more concentrated industry. Banking is going to be a more concentrated industry. It's going to be much harder to be a small bank. And, even bigger picture, all of this makes it much easier to say, well, what we need is more government support for these smaller and mid-sized banks. And we need to do more subsidies, or they're not going to be there. We need to have, it becomes more of a government utility kind of operation. And it, again, justifies even more regulation. So you have a situation where you're pushing all of the incentives to go into government funds as opposed to private funds. So that's taking money out of the private economy and funding the government instead of what would otherwise be productive activity.
Well, we're getting close to the end of our time together. I appreciate you. I know your expertise is in demand these weeks more than they otherwise would be. But I'd like to ask our expert guest. It's easy to criticize, but if you were given the keys to the kingdom and made king for a day or a week or a year, you mentioned some of the things you would have done differently in Dodd-Frank 10 years ago. What would you do if you were either head of the Fed or someone in Congress who really cared about the health of the U.S. banking system? What do we need to do? What do we need to change?
Oh, wow. I would love that for a day or two. maybe more than 2 days. But what we need to do is the opposite of what we've been doing for the last roughly 100 years. We've been doing the same thing over and over again and getting the same result. And I'm not going to repeat what that is the definition of, but we've been doing more and more and more regulation, and we've been doing more and more and more federal backing. That does not make the system safer. It makes it more fragile, and we just keep going through the same thing. We need to go the other way. We need to pare back. I would repeal Dodd-Frank. I would bring the deposit insurance limits back to the pre-Dodd-Frank coverage limit, which is still going to be about 10 times what the average transaction account holds. So we're not talking about hurting the little guy here at all. Okay, that's just not it. We would have a deposit insurance limit of about $50,000, whereas the average transaction account's only like $5,000. So and the idea is to bring more market discipline in, and you're not going to have a private market for deposit insurance and other risk-based other risk enhancements for those uninsured accounts when you keep covering it with the government. There's no reason to start a company to do that. So those would be my biggest things. I would repeal Dodd-Frank. I would shrink the deposit insurance coverage limit. And I would also do some Fed reforms. I would stop letting the Fed do all these facilities. They come up with the special lending facilities. They have emergency lending, systemic risk exceptions. Well, if you repealed Dodd-Frank, you would repeal some of what was changed there, but I would take the whole thing out. Section 13.3 for the Fed, I would get rid of the whole thing. You would make them a lender of last resort, but they already had a facility to do that. That's the discount window. If somebody doesn't want to go to it, that's fine. That's their problem. They didn't really need it. So, I mean, those are the things that I would do off the top of my head.
So I don't want to put words in your mouth, but in a sense, without all that regulation, what manages banks, what disciplines banks is market discipline, not regulation. Is that a characterization?
No, that's exactly right. So you're still going to have minimum capital ratios and all that kind of stuff. And you're going to have banks that are wanting to tell people, hey, look, this is how sound we are. And it's going to matter because if those depositors who are over the limit have their money in there, they want to believe that it's safe. They want to know what you're doing. And that's market discipline, right? And if we don't do that, we end up where we are now, where everybody looks around like, well, I don't know what they're doing. Why would I care? My money's covered.
Indeed. And it's so the cycle goes, more mistakes caused by regulation and guarantees, and we pile more regulations and more guarantees on top. So,
That's
okay,
right.
well, we've run out of time. I hope it didn't lead the witness too much. You're really great. Our listeners, I'm sure, want to learn more. It's a complex topic. We maybe didn't think about this since a global financial crisis. Where can our readers follow your writing and learn more about your perspective?
Oh, thank you for asking. If they go to cato.org, you'll see all kinds of things that my guys have written, me and my folks here in CMFA. Our blog is Cato at Liberty, and I've also got a Forbes column. If you just look up Norbert Michel Forbes, Google that, you'll see all my columns. I put things there too. So any of those places would work.
All right, wonderful. Well, you've got, I hope, a few more followers now, and keep up the good work. We appreciate it. I appreciate your writing, and thank you for joining me today on Hubwonk.
Oh, thank you, Joe. I appreciate it.
This has been another episode of Hubwonk. If you enjoyed today's show, there are several ways to support Hubwonk and Pioneer Institute. It would be easier for you and better for us if you subscribe to Hubwonk on your iTunes podcatcher. It would make it easier for others to find Hubwonk if you offer a 5-star rating or a favorable review. We're grateful if you share Hubwonk with friends. If you have ideas or comments or suggestions for me about future episode topics, you're welcome to email me at hubwonk@pioneerinstitute.org. Please join me next week for a new episode of Hubwonk.